Okay, good afternoon, guys. Welcome to another live trading clinic with me, Steve Ruffley. So, today, focus on the Bank of England. Unfortunately, all analysts have gone for 52, that is, have gone for unchanged today, so I'm not really expected to see any major surprises, but it gives us some time to kind of analyse the markets before the big event of the month, which is non-farm payrolls tomorrow. So, as always, we can go through the charts, go through some live charting analysis. If there's any products in particular you want to go through, just let me know, and I can tell you exactly what I think. It's not really that interest rates today are going to remain on hold. I think everyone's expecting that, and that's how the markets are positioned right now. I think the main thing to understand is the cycle that we're moving in. A lot of analysts now are saying that they're going to be happy when interest rates start to go up, because that is a true sign the economy is actually self-supporting, that it is back on track. Now, I've said on FXstreet many a times that the Bank of England was going to be first to move on rates. It just was the most logical step. I think we're moving towards inevitability with the gap between the rich and poor in London, the gap between the rich and poor in the UK in general. So this reliance on people in the UK to have a store of wealth in the property, it just isn't going to end well. It's just as simple as that. I mean, I know we've still got a shortage of houses, so it keeps pushing the demand for houses up, and all, therefore the cost. But we'll get to a point where it's just unsustainable when you've got people, having to borrow, 8, 10, 12 times the salary to be able to just buy a house. And we can't just carry on. I mean, when my parents bought their houses, they've done nothing but go up. They don't know any different. But that isn't the same for the up and coming generations of people. You can't just buy a house now and expect it to go up, 2, 3, 4 times its value in the next 10, 15 years. So all these things are cyclical, and they won't last forever. It's just as simple as that. I don't make the rules. It's the rules of the economy, rules of the world. So before I start, as always, guys, risk warning. Remember that spread betting and CFD trading carry a high level of risk or capital, causing losses and achieving this deposit. Remember, it's for everyone, so please ensure you fully understand the risk involved. The information provided herein, and also circumstances considered not for us as testing invest. Nothing here should be issued investment advice. The information provided is believed to be accurate, and the data is produced. Education only. Content of webinars, personal opinion with the moderator, not insurance.com. The content is not constitute financial investment or factor advice. Insurance.com is not accept any liability of the content of the session. So what we're going to go through, as always, live charting analysis. As I say, if there's anything you guys want to go through in particular, type it through in the chat window, and we can go through any currency pairs, any products, up to you. Multiple time frame trading, again, that's the only way I know how to trade. Basically, look at the higher time frame points of interest, put them onto your charts, use tools like RSI, Fibonacci. Again, the more basic for me, the better. You try to go for the self-fulfilling prophecy of technical analysis here. Currently writing a book at the minute, The Rough Guide to Trading. I know, a bit cheesy, but made sense. And it really is all about, the last 10 years I've been in the markets, how I've seen thousands of people's trading trading strategies. And realistically, what you need to go back to is not trying to find that secret system that only you know. It doesn't exist. What you need to find out is what the market itself is trying to achieve, what the majority of market participants are basing their trading decisions on. And then basically trade with them when they're right, trade against them when they're wrong. So, again, if you're trying to turn things on its head, everyone keeps searching for, the secret system. The Facebook's full of them. You've got these guys, posting on Facebook that we've got this amazing system that all you have to do is pay $29 a month and you're guaranteed to make money. Is that really going to happen? No, it's not going to happen. So, again, it's just going back to basics. There's nothing new in the markets, to be honest. It's just basically going back to what consistently works for you. So, finding a way that allows you to interact with the markets and be profitable more times than you're not is the only real way to survive in trading. It's that simple, basically. I've got the account open, so any trade we see today, I will put some on. And as always, Q&A, guys. So I've just got a selection of currencies up today and the FTSE. So basically, you can see how my mythology and my idea of the charts work. What I'll do is I'll put higher time frame points of interest, weekly, daily, and I'll tie that in with a fib. So my fibs, I just put green and red lines to indicate tops and potential targets. No more complicated than that. So as I keep saying, the fibs that I use on the H1 charts. So they ripple through what's happening in intraday trading. Now, you don't have to be a genius to see that these levels work. Again, these fibs are drawn from this area of activity here, but they still have a place within the market. As we move on, we'll see this, the market try to attack and to make some new highs, the euro versus the pound. Can't. Closes below the 50%, finds support resistance on the 100%, and where does it go? Well, within 2 hours, it gets down to the 161 spotting. Then, gets down to a daily level, can't close below it, comes back up, goes back to the 100%. So I could just go through the chart and, mirror all them things that I keep talking about, but, that's why I've spent years and years and years and years charting and putting things down as simply as I can. So there is no real interpretation. Okay, when it closes below the red lines, 50%, it goes down. When it finds a point where it can't go any further down, it goes back up. I mean, to make charts this simple, I cannot explain to you how many man hours have gone into making a chart look like this. I mean, we're talking probably tens of thousands. That's no exaggeration. You need to focus on what works, what the market looks at, tied in with something that's simple. So you don't have to have Ichimoku clouds. You don't have to have, interpretations of Elliott wave. You just need to know what it's done in the past to predict what it'll do in the future. So what's going to happen in the euro versus the pound? Well, we haven't completed the down move yet, so there still is the potential to get down to 0.81790 on the hourlies, and that would really kind of tie in and retrace this entire up spike that we saw. Or most likely, we've now found good support on the low levels of fib. We're going to try and get back to the 50%, which will close this gap here. The gap's already obviously been closed, but again, what was a point of interest and attraction in the past, back in the 28th of Feb, will come into play further on. So I would say once we break above the 161, the 100% will be the target. There's that, again, it'll fill in the momentum here, and then, we'd look to get back to the 50%. We look at the daily charts. Again, we're making consistent lower highs, so we're still you don't need, you can draw a channel here with, with your eyes closed, and that's just a perfect down channel. The basic charting tools are always the best. I mean, that's one-on-one charting, isn't it? I mean, basically, what that tells us is we're ultimately going to go down, but in the short term, I would say that it looks like we may, get back to the moving average on the daily and test this upper band before we then come down. So that's another mistake that people make when they're trading, is looking on getting in the right positioning in the market, but getting it wrong for timing. We can all say with infinite money, infinite time, infinite margin, we'll get trading right. Because if you hold a trade long enough, of course it will come back, and of course it will go in the direction you thought. It's very much like going to a casino and saying that all I have to do is basically, go into a casino and double up. So if I'm playing, red and black on a roulette, black, 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 black has to be red, at some point. So just keep doubling up. Trading's not about that. You have a finite amount of money in your account and a finite money to be used with leverage, and that's what trading is. People don't understand this sometimes. That it's not about being right. It's about being right at that time. I can be right and tell you that the FTSE is going to drop 1,000 points, but I can lose everything in my account by being wrong for one day. The market can go up 200 points in a day. I'm sure I have to get out, then the market dumps 1,000 points. Okay, so it doesn't matter if you're right overall. It's being right at the right time. So if you think, going back to the hourly charts, that, the market's going to come off. Well, if you look at that daily, line we drew in for the trend channel, well, potentially before it does sell off, it might push up 50, 60 ticks. So that gets us back to the 50%, test these upper fib levels before it then came down. So it's one of these things, isn't it? It's kind of, if you can take on 60 ticks of potential offside position, because you want to go short now, expecting the market to come off, that's fine. But if you don't, then wait. Wait for the market to hit the highs and sell high, rather than sell really, kind of when we're in these current ranges. So again, it's one of these things, guys, it's timing in the higher time frame level, what the market could potentially do before it does what it has to do. Now, we can all sit here, and I would say that 99 times out of 100, when we're looking at the markets, we can predict that it's going to go up or down. I would say that goes down to 25 times out of 100 that we actually make money from that. So that's what makes trading so very difficult. is you can have the right opinion, and still lose money. So basically, I'm very, very negative the euro anyway. You don't have to, if anyone who's listened to me in the past, I don't think Europe's fixed. I think the problems with unemployment are still, been swept under the carpet. I don't see the European Union as one union. I see a lot of bickering, selfish member states. And Germany, Germany's put a massive bet on the euro, and it's kept it bankrolled. What happens? What happens if Germany run out of money? Because Germany is certainly not the United States. And did Germany have all the answers? Nah, I don't think so. But anyway, that's just my opinion. So, euro versus the pound, I think we've got 60 ticks or so, potential up move, but then I'm expecting it to go down. But again, take a screen print. Simple as that. Take a screen print of these levels here, okay? And then check against the close, check against, trading in 12 hours time, and see how these Fibonacci levels and these dotted lines I've got in, act as supply, support, resistance and support. It's spooky. Again, these lines have been drawn in for days and days and days, and how is it a coincidence that the market, opens and closes around this bottom level here and then moves up? So, before it goes down, it has to get to here and here. It's as simple as that before it even attempts to go back down. Similar scenario in the pound versus the US dollar. Seen a bit of strength come in over the last few days of trading. We're focusing around this key 50% retracement level. Market's not really, made its mind up just yet. So what I would do is probably tie in some of my other indicators that I like to use. So I said keep them simple. The RSI is about as simple as indicators get. If it's above 70, it's overbought. If it's below 30, it's oversold. So right now, we've rejected the overbought. Again, we haven't made an attempt to make a higher high and push the market back up. The demarker indicator spent a lot of the time in the Burr reversal. We've come back down. We've bounced back over the 50%, but it looks like they're coming down. So looking like we want to get to the oversold territory. We're looking like we want to get towards a bull reversal, but we've got to go down in the meantime. So I would say the more we close below this level here, at 1.67207, the market's going to go down. We're going to test this 100% fib, 1.66999, and then we've got two nice levels, 1.6666, 1.66742. So basically, I would say that you've got between 50 and 40 ticks potential downside move. Okay, so as long as this hourly candle closes below this 50% level here, I would say that you've got a 70% chance of the market at least breaking the lower Bollinger Band, touching this level here. If we break down, we've just got these voids to fill. That's what you're looking for all the time, voids to be filled. Yeah, because these lines, these levels are what the market is looking for. So the market will get down to here because people want to buy here. The market will get down to here because people want to buy here. So it'll be forced. Sellers will force it down till we find buyers to push it back up. Just as simple as this markets work. In the FTSE, we've got a bit of a mixed bag, really. I guess everyone's waiting, probably for the non-farm payroll tomorrow. We saw the ADP come out, expected 150, came out 139, so a little bit less than expected, but didn't really affect the markets that much, to be honest. ADP seemed to be a precursor for non-farm payroll, but it's notoriously unspectacular, the correlation, to be honest. It's either a brilliant precursor for it, or it's not. As we've gone through, it's simple as this, isn't it? The non-farm payroll was so particularly difficult to predict that there's absolutely no point, trying to outguess it, trying to second guess it. I've been predicting non-farm payrolls for 10 years, and I've got it right a couple of times. But the times I've got it right are, funnily enough, the times that I've made the least money. So it doesn't really matter. What we have to do is wait for the figure and trade the aftermath. So I'd say in the FTSE, realistically, it wants to push down. Okay, I think a lot of people got caught on this unusually strong move up to the FTSE. When we look at the daily charts, it's pretty obvious. I was selling some FTSE down here. That didn't end well. But, these things happen. If you just do a basic Fibonacci on the dailies, you'll start to see some interesting points. You've got the natural level the market wants to get back to is this 50% here. We've made the higher high, but it feels like it was not manipulated, but it feels like it was forced up. You see back in history, back in October, the markets broke above, this daily resistance point here. And it didn't didn't feel like it wanted to stay there. Then we saw the indecision. Then finally, the market started to move down. So we've seen the same kind of move here. Market again, indecision, makes a high, tries to make the second high, closes with a bit of doji, and then sell. So the market now has rallied back up. But I don't see any great news. It depends on the non-farm payroll, what's going to happen, tomorrow. But realistically, we're going to do the same scenario. So if the market went up, couldn't hold, came down, that's probably 50% here. Market came up, went back down for 50%. So the market here is going to do the same thing. So all we do is do a low to the high, do our fib, find the 50%, put it on there, and then wait for the hourlies. Okay, so wait for the hourlies, and that tells us that here is a good level where the market can get to. We're well below the 50% on the hourly chart. We're failing to make these higher highs. So when the market finally breaks this up move here, it's got nowhere else to go apart from the 38.2, the daily fib. The over retracement for the hourly, the 423. So again, it's just all downside target. 80 ticks, 100 ticks. We're 143 ticks away from that 50% on the dailies. So that's what I'm talking about when using higher time frame levels. You figure out what the dailies can do, and then you look on your 4 hours, again, consistently making lower highs, looks like a nice downtrend channel. So if we don't get back to make some new highs, based on data, based on any kind of, sentiment, then the market's going to break all these lower levels, and try and, get back to that 50%. Because really, realistically, you only need to look at 3 time frames. Everyone likes to kind of say, if I go back, far enough in time or have enough data, enough tick data, I can backtest anything. It doesn't work like that. Because if you backtest 10 years worth of data, unfortunately, quantitative easing wasn't around 10 years. The problems in Russia weren't around. The problems with oil weren't around. It just doesn't make any sense to go back 10 years because you're purely then just trading technical movements. My rules, again, just my rules, but 80-20. The market will move 80% of the time technically, 20% of the time fundamentally. So your fundamental moves will still move in a technical manner, but they're based upon what's happening right now. The markets, we as people, the markets, the economy are not the same as they were 5 years ago. Weren't the same, the same as they were 10 years ago. So you have to, understand what's going on now and factor that into your trading. So the 3 time frames you need to use for me are daily, hourly, and 15 minute. Every 15 minutes, you get an hourly signal, and then your daily levels provide you with enough framework to trade of your hourly charts. So simple as that, really, guys. It's making it manageable, making it work for you. Now, if you just go for the hourly charts, well, then, you buy. You buy when you break back in to the fib level, and your next target is the next fib level. Or you sell when you get close to a key fib level, and tie in with the Bollinger Bands. Again, you close inside the Bollinger Bands, you've got 1, 2, 3, 4, 5 green candles until you hit the opposite Bollinger Band. Yeah, fib, close inside the Bollinger Band, 1, 2, get to the lower Bollinger. Okay, so it doesn't really matter how you do it, but, you have to kind of tie in the technical indicators with the kind of market sentiment and just go with the highs and lows. Like I said, it took me almost a decade to kind of come up with something that was visually, right for me. I'm a very visual person. I like to be able to look at things and then instantly say, right, well, okay, we're getting a bid come into the market, so buy my green fib lines, get to a red line, sell it. Gets to a red fib line, sell it, buy back at a green line. That's just the way my brain works. So I try and color code my charts in a way that I understand. And that's the only way any of us can trade is through what we understand as traders and what we perceive to be, the right way of technical analysis. Yes, okay, so, market's got a memory, absolutely. Mr. C, can you show us the starting point for fibs? Funnily enough, Mr. C, I can't show you the starting point for fibs. I could do, but I'm not going to, because the whole point is, this is my version of how I draw fibs, and you can't actually draw my fibs in by hand. A combination of fibs and extensions, so you can't actually just draw it in by hand. It's something that can only work with the way I've set up my charts. So I'd love to be able to tell you that, Mr. C, but I can't. I can't physically show you that, unfortunately. What I would say is just pick a point. Pick a point in the market that looks like it's gone too far. What I would say is, what you have to do is look for these kind of candles. Okay, so these kind of candles, anything that moves in a straight line that much, it's going to get people caught out, people on the wrong side. So what you want to look for is a key point on the chart where people have experienced pain. So if people will long the low Bollinger Band and it's 100% here, then there's no way you'd be able to hold your long trade to here, then to here. You just wouldn't. You'd be out. So look for where the market feels pain. Wherever the market feels pain, there'll be a retracement. So I would say draw a fib from the low to the high here, and then that 50% will act, as some sort of reference point within the market. As Zahid rightly said, the market's got a memory, and the hourly charts for me are where the majority of institutional traders look. So that's where they will pick their levels from. So that's where the memory of the market comes in. Nobody picks levels off 5-minute charts or minute charts. That's why they're irrelevant in trading. Okay, so you have to look at what other big market participants are looking at. Because, any trader worth his salt, a big trader in the city, won't be trading off, 15 or 5-minute charts. I only say that the 15-minute chart is relevant because it's good for your entry point. So, for instance, if you wanted to trade, how can I set this up? 1 second. Okay. 1 second, guys. Seem to have a little bit of a problem with MT4 here. Okay, that was interesting. Okay, guys, just 1 second. Seems to have a slight meltdown with MT4. Okay, guys, just bear with me 1 second. Right, let's try something else. Okay. Sorry about this, guys. Seem to have a little bit of a meltdown. Okay, we've got about 7 minutes or so before the Bank of England. Again, we expect it unchanged, but as I say, it's really what's going to come through. I mean, we know that Mark Carney's already made a big backtrack about linking interest rates to the unemployment level. That's already come down. So I think really what we're looking for from the Bank of England is an indication of when. I mean, it's inevitable now that interest rates are going to go up. I mean, it's been inevitable for quite some time, but we're talking about the first quarter of 2015. Is that too early? I don't think so. I think that it's really time that the market saw some attack on these inflationary pressures that we've seen, and interest rates are the only way of doing this. Right, no idea what's going on there, guys. Seems that technology. Okay, gonna have to go to a plan B, guys. I've no idea what's happening with this here. Let's go to... This again just illustrates on the hourly charts, what my whole kind of ethos is. So the market does want to get back to the 50%. The more we hold above, these key levels of 38.2. If we then close above the 23.6, then in this particular type of scenario in the markets, we have to make a new high. So that's what I like about Fibonacci. It's an either-or trade. So the market's either going to keep making lower lows and get down to the 50%. But if it doesn't do that and it keeps finding support on the 38.2, and the 23.6, it's going to make a higher high. Yeah, does that make sense? So, again, for the short or mid-term trader, these kind of things are valuable. I mean, you see the market, a lot of these kind of pin bars, rejections of a ability to close lower. And the more we do that around the 38.2, the more likely we're going to hit the 23.6, hold above that, then we have to test these highs here. Okay, so that's what I like about Fibonacci. That's what I like about charting and trading in this way. It's very if you set your charts to the right way and you just put all the products you trade on the hourly, it makes it that much more black and white. That anywhere that you find we're significantly above or below the 50%, you've got targets where the market will move to. Yes, Steve, yeah, the meeting minutes, yeah. Okay, well, we've got a couple of minutes before it comes across the wires as to what the Bank of England are doing. 52 analysts, as I've said, have gone for unchanged. But just see if there's any comment or there's any kind of indication or any kind of speculation that comes off the back of this. Now, interest rate rises or the hint of a rise is negative, okay? So that will initially send the FTSE down. In my kind of views, it's good. So the market, I won't buy any significant dips based on that, because actually, if the Bank of England think that interest rates in the UK economy can stomach that, then it's got to be, long-term good. So I would buy any dips, but you should see, if it just came out and said interest rates, rise 0.25%, then you would see the FTSE very, very aggressively sell off and probably retrace all this movement here. But realistically, we know that things move in cycles. We know that, we've got the risk of the housing bubble. We know inflation's way above target, has been for 6 years. And we know that interest rates are the only way to kind of get around that. So, just a minute or so now before we hear the Bank of England. As I say, if it does anything but unchanged, then we're going to see some massive movement. But 52 analysts going for unchanged. Okay, it's just a minute. So yeah, just about 30 seconds or so, guys. So yeah, I mean, again, I'm just listening to the squawk and to the analysts now. We've got 20 seconds. Everyone's saying it might be a non-event, but got to be here, guys, haven't we? Got to be here, just in case. Okay, about 15, 10 seconds. Five seconds. Unchanged. Okay. As we expected, 52 analysts unchanged. Let me just listen to what's coming through, guys. 1 second. Okay, seems that really kind of nothing's really changed. Asset buyback seems to be staying as on target. So that's 375 billion. Asset purchase target has not changed. So the core base rate unchanged, the asset repayment unchanged. So pretty much status quo. So you might see a little bit of a bid, I would say, going to the FTSE. Okay, I mean, to be unchanged is what was expected. We're already kind of, people were going long, and the markets, retraced this down move, in the last kind of, 4 hours of trading. So I would say maybe we look to make a bit of a test to this level here. And again, the Fibonacci principles, if that kicks in, if we see no bad news, and we see nobody kind of taking positions based upon a bad non-farm payrolls tomorrow, then realistically, you'd think the FTSE is going to try and make a new high from here. But if it doesn't, there's a massive target here. I'll just put a line in. The massive target, is this level here, 6771.8, and then if we break below that, it's going to be 6753. So that's your 3 targets in the FTSE today. Pretty much as simple as that. We're going to go up or we're going to go down. So it's all really going to pivot, I would say, around this level here, the 23.6. That if we close above that, the market makes a new high. If we reject that, the market definitely looks to test 6771.8. And if it breaks below that, it's going to get to 6753. So I mean, that's how using the simple terms and the simple things like Fibonacci and the simple kind of hourly view versus daily levels gives you that guidance of where you want to move, between, trading levels. That's all the market is doing. It's constantly searching for support, resistance, for value. So if we don't find any value here, the market's going to come down. If we do find some value here, the market's going to push up and make some new highs. So it's just really as simple as that, to be honest. Any thoughts on that, guys? Any thoughts on? I guess nobody's surprised that Bank of England stayed on its current course. But do you think the Bank of England will wait till the first quarter of 2015, or do you think that interest rates are going to move sooner than that? Any thoughts on the UK? Any thoughts on the European Union? Any thoughts on what Draghi's going to do? Any thoughts on what Yellen's going to do? I mean, obviously Yellen's come out and said she's going to continue the same stance as Ben Bernanke, but who knows? A year's a long time, isn't it? We're only in the first quarter of this year. Okay, Steve saying 2015. Okay, good man, I agree with you. And David saying the Ukraine will be a big factor at the moment. Yeah, I mean, absolutely. Anything in the news, again, I mean, I can only go back to the things that I know. I mean, there are 3 things that move the market, okay? There are key speakers, policymakers. There's information from data, so things like non-farm payroll, and there's key global events. So I don't think anyone can deny the key global event is the problem with Ukraine and Russia. Now, it's not that anyone particularly cares about the Ukraine. I don't think anybody does. I mean, I'm not saying that in a kind of, a nasty way. I'm saying, from a kind of what it contributes to the world economy. We're not looking at it like that, Ukraine's going to be, unable to produce whatever it produces, on that respect. What we're talking about is the effect of Russia. Now, there's a lot of Russian money out there. Don't get me wrong. The UK does not want to severely, cut any ties with Russia because, the London finance economy and the property market does very well out of the Russian, kind of elite, the millionaires and billionaires. So we don't want to rock any boats there. So what we're talking about global events. We're talking about things that will affect the price of the dollar versus the ruble, for instance, or maybe the effect it'll have on commodity prices, people looking for safe havens like gold. So these are things that we need to look at when we're talking about the Ukraine situation. We're not talking about, Ukraine's currency. We're not talking about, Ukraine's ability to function as a country. We're looking at the ripple effects. What will be the relation between the US and Russia? What will happen if Russia, are voted out of the G8? What effect will that have? We've already seen a massive drop in the Russian stock market. I think it was down 12-13%. So that's, the markets will always punish countries a lot quicker than any troops or any sanctions can do because it's so efficient. Okay, so if we think that Russia are going to cause a major global headache over this, then the Russian currency is going to go down in value, the stock market is going to go down in value, and there's going to be real consequences of their actions. Not just to say, we're going to put sanctions in, maybe, again, as I say, kicking out the G8 or, put trade embargoes, all these kind of things. They take time to filter through. They take, days, weeks and months. But the currency markets take seconds. And, there's a clear example of the dollar versus the ruble, where basically the dollar jumped up, 55 points and gapped against the Russian ruble, just because, it came out on the news wires, that there was going to be this tension and conflict over the Crimean. So, these things, the markets are the best way to understand what people are thinking, because people vote with their feet, they vote with the money, put the money where the mouth is. And if people start buying the dollar against the ruble very aggressively, then things are bad for Russia. Simple as that. Ian's just saying, good to see Ian, more likely that Draghi will act before the Bank of England. Yeah, well, Draghi will act before the Bank of England, but it'll be something else. It won't be a good thing, will it? He's still talking about negative deposit rates and even cutting the base rates of interest rates. So it's not the European Union is nowhere near fixed yet, because they're not talking about putting interest rates up. All they're talking about is extra stimulus for banks and for putting prices, if anything, interest rates down. So yes, I mean, obviously it's a different situation, a different kettle of fish, should we say. Okay, Zahid. Usually they wait longer for the lag for these things to work. Yeah, but there's always a lag. I mean, that's why it's interesting, isn't it? There's a lag between everything, that the governments do, because they take time to implement. What I like about the markets is they're so efficient. And, if we hear some bad news now, the markets will sell off. If we hear some good news, markets will go up. So we're getting towards that 6,795 level in the FTSE. So again, see what the market does above here. If it closes above, makes new highs. Closes below, gets back to the 50%. So you've pretty much got, this is your pivot point for today in the FTSE. Close above this in the hourlies. Steve Ruffley says it makes a new high. Closes below this point here, it's going to get back to the 50%. Okay, I cannot make it any more simplistic from a technical perspective of how to trade, the markets based upon simple strategies like hourly candles versus Fibonacci. Okay, Martin's just saying, I'm Putin, new market maker with inside info. Yeah, that's a pretty cynical view, but yes, I mean, Putin, would you trust Putin? I wouldn't trust Putin as far as I could throw him. What I like about Russia is just their absolute inability to have any kind of consistency. They've let some political prisoners go, people they've had locked up for years in Siberia, some band and some random billionaire. And then it's like, oh, well, we're going to host the Winter Olympics, so yes, we're civilized, let's all these people go, aren't we a nice nation? And then they do the Winter Olympics, that's out of the way, right, okay, next thing, let's crack on, let's go and invade the Crimea. So they're just absolutely out on their own. I mean, Russians are a very kind of unique breed of people, and they see the world in a very different way. And you have to think about, Russia, I mean, it's so massively divided. You have your super rich and, you're insane rich. I mean, I've dealt in small amounts and seen an inside glimpse into billionaires and of the Russians, and it's crazy. It's absolutely insane. I mean, I could tell you some stories, but I won't. But let's just say, they're not seeing the world through the eyes of normal people. That's for sure. Russia's not a country, it's a state of mind. I like it. Do technical traders need to be concerned at all with those fundamentals? Do you know what? For once, that's a very good question, Boki. Very good question. Yes. Yes, they do. Now, a lot of quants, a lot of technical traders will tell you they can fade out any fundamental news. Now, what's the point in doing that? If you understand the news and you're intelligent, then you trade the fundamental news from a technical bias and improve your position, or trade in the short term to make some money, right? Now, I have a basic rule, as I've said before, of 80-20. The markets will move 80% of the time technically, and 20% of the time fundamentally. Now, even a fundamental move will move technically. So even if there's another 9/11 type scenario, the markets will move down a certain amount and retrace the 50%. It's as simple as that. Okay, anything that moves in a quick enough, big enough, volatile move will retrace to 50%. It has to, because that's the way markets function. So I'd say that you don't always have to be aware of fundamental data, But would you trade at 12 o'clock tomorrow and go long the S&P? No, you wouldn't, because you're going to wait till 1 o'clock or 1:30 when the non-farm payroll comes out, because you know there's going to be that short-term volatility. So if you know these things, why don't you plan around them? Why would you just purely trade technically and not ever listen to the market sentiment or listen to the things that make up the way the markets move? Doesn't make any sense to me. Okay? So for me personally, you have to keep one eye on the fundamentals at all times. So that's your key data, key speakers, and have the news on to see what world events, like the situation in Russia, will move the market. So these things for me, guys, are kind of, again, these are the things I'm writing my book on. I almost feel like, I don't know, I always feel like I'm cheating. I mean, I take these things for granted, but I've dedicated the last 10 years of my life to charting and understand how markets move. I've written software, I've written for the Times, Bloomberg, Reuters. I'm not just saying these things for the good of it. I'm good at what I do, and I tell things the way they are. I don't have any time to reinvent trading. It's just too hard. So I put into my charts the things I understand, which are higher time frame levels, fibs and pivots. Sounds simple, but to get this combination and to get it to work for you, it's very, very difficult. And to have the confidence to trust your system and to trust the way you trade is also very, very difficult. And that's the way, the turtle traders traded. And you see these big kind of, back traders and these trading groups work because they get a system, they understand how it works, and they play the percentages. So even if they lose 20% of the time, they're winning 80% of the time. So in the game, they're making money. And that's all we are all trying to do constantly in trading. Yeah, I mean, exactly. I mean, as Zahid said, I mean, it's staying out. Anyone can say, the market's going to go up, market's going to go down, but it's being in the market for the right time and the right place. I mean, that's really what we're trying to do. I mean, what I'll say is, if you want to kind of understand how I trade, I've started doing some short videos, and I'm just putting them on YouTube. So if you want to see how I trade and how I kind of build, information up through the charts, just have a look at some of the videos I've made. So I mean, again, we've got a little bit bid in the FTSE, so if we close above 6795, the only place we can test is these highs here, and again, this new high here. So it's not like it's a complicated way of trading. Markets can range, they can go up and then go down. That's pretty much all you can do with trading. All right, guys. Well, any final questions? Any final thoughts? Sorry about the little technical problem we have with MetaTrader. I don't know, for whatever MetaTrader have gone away and changed everything about their operating system. It's caused nothing but problems, so I don't know why they've done that, but these things happen. Anything else, guys? Any final questions? Any final thoughts? No, well, thanks to FXstreet. Thanks for you guys attending. Big one tomorrow, obviously non-farm payroll, so the markets will be probably quiet later on in the trading session waiting for that. Anything else you want to know, guys, just get me on Twitter, @SteveRuffley. It's been a pleasure. All right, guys, have a great afternoon.